Glad that some people are here for what will be a very good conversation around HIPS. And I don't mean the body part. I mean the ticker HIPS. The hips don't lie. Exactly. That should be the slogan for HIPS. For those that are here that are financial advisors, do me a favor. If you have to be physically in an office, please tell other advisors that this webinar is taking place. I have been traveling the last 7 weeks. It's been quite a bit of back and forth away from home, and now I'm back in action and going to be getting back in the swing of things with webinars with sponsors and clients and great people like Will Rind of GraniteShares. So for those that are here for the CE credits, do me a favor, stick around to the end of the presentation. We'll probably keep this to around 30, 40 minutes or so. I will email you afterwards, get your information, submit that to the CFP board. So stay tuned for that. And with that said, I want my friend, Mr. Will Rind of GraniteShares, to take from here, talk about HIPS, alternative unconventional income.
Exactly. Well, thank you, Michael. And thank you, everybody, for tuning in today to this session. And we're doing this today because obviously after yesterday's rate cut, I thought it'd be a good time to remind everybody in now what is almost certainly a declining interest rate environment towards the end of this year about how to generate yield in a portfolio. And there are still places to go for high yields and different areas of the market where you still get an attractive risk reward return when maybe the nice returns or the nice yields that you've been used to seeing from short-term treasuries or from money markets by the end of the year might not look so appealing. So with that, let's jump into it. Now we're going to talk a little bit just between us. So I'm going through a presentation, but at the same time, it's really just to sort of reference this conversation as we go along. So for those of you that don't know us or are not familiar with GraniteShares, we're an ETF issuer. It means we're an asset manager that focuses exclusively on the creation, the launch, the management, the marketing of exchange-traded funds, all things exchange-traded. We're a global company based here in New York City, but we have a presence all around the world, including major Asian markets, and running somewhere between 10 and 11 billion of AUM these days. We do a number of different ETFs. There are actually too many to fit on these different pages. So you just get a brief snapshot of what we do. But suffice to say, we have a lot of different strategies in our, portfolio that range from commodity-based ETFs like physical gold or broad commodities to growth equity, income, in the case of options income on our yield boost family, leveraged ETFs on single stocks, and of course the subject for today, which is our HIPS ETF. So a lot of different products available for all sorts of different investment needs. But again, we're going to focus on HIPS today. So as I said, in light of the rate decision yesterday, and in light of expectations that we could see another couple of rate cuts towards the end of the year, and maybe magnitude still somewhat in question, but let's say, for argument's sake, around 75 basis points, maybe more, between now and the end of the year, that it's worth talking about the income environment again. And again, maybe just to step back a bit, that, just to frame this conversation, that, from a historical perspective, up until the last few years, we were in an environment where the majority of return that was coming from fixed income investments was coming from capital gains and not from yields or from income generation. And that all changed, obviously, when the Fed started hiking interest rates. We started to go into a rising interest rate environment. And in that particular scenario, people lost money in bonds from a capital perspective, and yields improved, significantly in that time. So now that we're at the top of that cycle or on the other way down again, what can investors do about a scenario where we have declining interest rates? And again, we're back to sort of somewhat similar position before, where we have a more volatile fixed income environment, where people have experiences gains and losses, and yields that are sort of fluctuating. Is there anywhere we can get more stability in terms of yield and portfolio. So this chart here shows a little bit of the historical context just displayed in chart format. And what you're looking at here is the 10-year treasury in blue against the ag total return in red, and then the ag dividend return in sort of orangey yellow color. And again, just to show that environment where rates are falling, that bond prices were rising, and people did well in the ag, but that growth or that gain was coming from a capital appreciation as opposed to income or yield. And now we're on the other side of that, where we're starting to see interest rates come down again. So for those of you that are not familiar, we're going to be talking about alternative income in today's conversation. So alternative income is a phrase that we use to describe what HIPS does. And this is a category that refers to non-traditional fixed income. So first and foremost, HIPS is not a fixed income ETF. We're not talking about bonds specifically. That we're talking about a type of security that is not a traditional either stock or bond, or a stock, a dividend paying stock in specifically. And, what we're talking about is a sort of subset of the market called pass-through securities. And pass-through securities are a subsection of the market, which are securities that are required by law to distribute substantially all of their income generated to shareholders. And so they do that uniquely without any corporation taxation. So pass-through securities are typically structured as pass-throughs, and therefore they avoid corporation taxes. How this looks in sort of practice is a bit like here, where we try and chart or show by way of a picture the difference between taking income from an entity, a corporation in this particular case, that is subject to corporation tax. And that's the top sort of three circles or bubbles. And then below, ones that are not subject, i.e. pass-through securities. So the bottom line here is when you have corporation tax in the middle, you're automatically receiving net income amount that is lower than if you were not paying any corporate tax. So to start with, when you have an investment in a pass-through entity, the amount of income that you're receiving is free from corporation tax, but you're starting obviously at a higher level of income versus the equivalent, which has been paid away in terms of corporation taxes. Now, for pass-through securities, there are four main sectors of the pass-through security world, which we'll discuss today, but namely those four main sectors are going to be real estate investment trusts, so REITs that invest in mainly a combination of physical property or physical real estate, and or mortgages, and the other type of REITs. So master limited partnerships, these are entities that typically invest in energy infrastructure, so oil and gas infrastructure, be it pipelines, etc. BDCs, or business development companies, these are entities that typically act as lenders or non-bank lenders to small and medium-sized businesses. And then you have closed-end funds, which can have a variety of different strategies, etc. But the ones that we're going to be talking about today are typically in the fixed income arena. And again, with all of these particular strategies or sectors, they are required by law to distribute almost all of their income to shareholders and do not pay corporation tax. So I think if there's one slide in this presentation to take away, then this is probably it. And we use this one to specifically describe the value that we perceive in HIPS, the ETF. And the bottom line with HIPS is we're trying to create an all-weather income portfolio. And what does that mean? It simply means that we're able to pay a consistent monthly distribution throughout market cycles. So in other words, it doesn't matter what the market is doing, whether the market's up, whether the market's down, whether we are in a high growth environment, a low growth environment, whether we're in a high inflation environment, a low inflation environment, that in all market cycles, we have a part or portions of the portfolio that will do well in these particular environments. So if you look here, what this is showing you is throughout the economic cycle, if you look at the respective quadrants here in this particular chart, whether you're in a high inflation environment, but a low growth environment, that's going to favor investments in the top left, like the cash-like investments, closed-end funds, particularly those that are involved in more loan strategies or mortgage REITs. And then conversely, on the other side of the chart, top right, I'm now looking at where you have a high growth environment and a high inflation environment. That particular environment favors something more like hard assets, or which is MLPs, particularly upstream types of MLPs, equity REITs, which own physical real estate. So there's always going to be something in the portfolio that can benefit in these different market environments. And obviously, given the track record of HIPS, that's exactly what's happened, over the last 10 plus years of track record. So HIPS is an index fund, which means that we're tracking a underlying index. Now, how that index is constructed is as follows, is that you start with the four main sectors of the pass-through security universe: MLPs, REITs, closed ends, and BDCs. And then you sort those or screen those for the 10 highest yielding securities in each sector and the 10 least volatile securities in each sector. And you put those together and equal weight them, and that becomes the portfolio. So you end up with an equally weighted portfolio that's represented across all sectors, comprising of the highest yielding securities with the lowest volatility. And again, the idea behind that is that we want to create a high distribution yield, but we also want something that is stable, something that is consistent and not super volatile. So if you look at what the portfolio holds today, you've got the top 10 fund holdings on the right-hand table. But of course, the beauty of any ETF in the market is, of course, you can go to GraniteShares.com, or you can go to most public websites that catalog this kind of data and see the holdings on a daily basis. So ETFs are completely transparent, and you can see these holdings. The top 10 here represented, and then the sector chart on the left-hand side, where you can see roughly equal representation for those sectors with a residual cash amount. And again, that's all available on the website, and you can look at that, download the holdings every day for not just HIPS, but for any ETF. So here again is performance that you can see on the website, be it the 1-year performance, the 5-year, or since inception. And again, that is performance which includes the distributions, and HIPS is distributed every month, a fixed distribution amount since inception, so over 10 years. And again, this is a representation of the performance since inception. And the important thing here, I think, in this table is just to show you really the one, worst case scenario, if you want to call it that, which was in 2020, or the COVID pandemic. And this was really the kind of worst case scenario for income investing. And remember, in this particular environment, when the market crashed, was also an environment where, we shut down the vast majority of the economy. And in that particular case, you had companies that were dividend payers in the market cutting dividends or postponing dividends. You had funds which were income or dividend-based funds that were cutting dividends and also spending or canceling dividends. And in this particular time, in the HIPS portfolio, we just had one security or one company, which was a hotel REIT, that actually stopped paying distributions. So even in this time, while the NAV, along with everything else in the market, crashed, the strategy continued to pay distribution every month without fail in this particular time. And of course, after the market started to recover, so did the NAV, so the portfolio value, just like everything else in the market. And we continued on from there. So it's really just to demonstrate that one of the good things about something like HIPS is you've got a long track record. And in that time, we've been through multiple economic cycles, different market environments, including probably what was the worst case scenario for any income or dividend fund in history, which was COVID. And again, probably the main takeaway, if you're an investment or if you're a investor looking for consistent monthly income, then HIPS really is the fund to consider. Every single month since inception, we've paid 10.75 cents per share. And, over time, we've never missed a distribution on a monthly basis. And so again, for somebody who values consistency of income, that is the core of the HIPS investment proposition. And, at the moment, and actually through time, that's always around about 10% per annum. So depending on, again, what the market condition is or the market at the time, it's give or take more than 10% or slightly less than 10%. But, the yield of the fund is around 10% per annum. One other important thing to talk about is that with any income fund, the taxation of that distribution is clearly an important talking point. And here there is a return of capital component to that distribution, which can help or does help in terms of making that income or distribution more tax efficient. And what we're talking about is here in the table, you can see every year up until last year, the historical return of capital per share. And that varies depending on obviously the year, from a high of around 80% back in 2019 to actually a low, which is 2024, of 15%. But there's a variable amount of return of capital. And just to be clear, that comes from the income component, typically from the MLP part of the portfolio. It is not from the fund selling assets and returning investors their own money. So that is just a tax consequence of owning MLPs in the main as part of the constituents in the portfolio. Another one to head off here, and this is why we have a slide on it, is that HIPS is a fund that is quite unique because we own BDCs. And because we own BDCs, we have a high total expense ratio on a relative basis. So if you look and you see 1.99%, this is to explain why that exists. And the bottom line is it's just because we own BDCs, and BDCs are taxed in a different way as far as declaring expense ratios is concerned. So BDCs are taxed like registered investment companies or 40 Act funds and mutual funds, as opposed to corporations. And therefore, the expenses required by the regulator are shown very differently to expenses, say, if you owned a corporation. The bottom line is that you have expenses or an expense ratio, a management fee, whatever you want to call it, that comes out of the fund's assets. So a management fee is something that comes out of the assets of the fund or the NAV. And then you have the acquired fund fees and expenses, which makes up the remainder of this over 1%. And that is just from or included in the price of the securities. So in other words, that doesn't come out of the fund's assets. So anybody that's familiar with buying BDCs or holding a BDC fund will understand this. But for those of you that are looking at BDCs or looking at a fund that owns BDCs for the first time, this might be new. It's nothing to worry about. You pay the management fee, just like any other ETF. It's just the disclosure of the expenses around BDCs are different or unique to BDCs. So I think one of the main things to touch on before we kind of get into a Q&A is like how you practically use funds like HIPS, in the portfolio. And what's interesting is that, when you talk about bond portfolios, you're exposed to interest risk and credit risk in the main. And the main thing, or the main advantage you get with alternative income, is immediately you're not exposed to such risks in the same way because it's a different asset class. So combining alternative income, with traditional bond solutions can potentially improve overall yield to the portfolio while reducing or maintaining a similar risk profile. And I think sometimes it's easy to contextualize this in a slide like this, where on the right-hand side, you have this bar chart where the different bars are represented by a representative index. So for example, with the equities on the left-hand side there in gray, that's the S&P 500 index. And so the annualized yield is about 1.2% per annum from the S&P. And then you move up, to the right in terms of the different, the higher the annualized yield for the different asset classes. And so you get to something like HIPS on the right, which is a combination of these multiple bars, be it BDCs, closed ends, MLPs, and automatically you're just in a different yield category to that of traditional dividend paying funds or traditional bond funds. And so that, I think, is a nice way to show the value add of more income, but to complement that with either traditional dividend paying stocks or bonds. And the correlations here, you have these different charts represented by the S&P on the left, the Bloomberg Ag Index in the middle, and then the 10-year government bond. So you see the R squared for the two on the middle, and then on the right-hand side, the fixed income R squareds, that is very, very low. So showing you that HIPS is not correlated really at all to traditional fixed income. And then on the left-hand side versus the S&P, you have a higher R squared, meaning that on the correlation front, HIPS is going to correlate more like equities as opposed to fixed income. And here's just a few slides to finish off in terms of what happens if you were to integrate HIPS into traditional strategies. So in this case, this is a government bond portfolio. In this case, this is 80% government bonds, 20% HIPS. And here you can see that by putting in a high yielding asset, such as HIPS, into a government bond portfolio, you're able to generate a higher total return in terms of that particular portfolio and increase the yield per unit of risk. And then similar here, this is integrating HIPS into a US Ag bond portfolio. Again, in this case, it's 90% Ag with a 10% weighting towards HIPS. And again, you generate higher total return performance or total yield to the portfolio, but you lower the overall volatility and increase the yield per unit of risk. So some potential advantages of HIPS: it's not correlated to traditional or conventional fixed income. So you avoid concentration risk. In other words, you don't double down on duration or credit risks. You have the very long track record, 10 years plus of consistent distributions of 1.75 cents per share every month. Diversification, equally weighted portfolio across the four main sectors of the pass-through security world, provides that all-weather income portfolio regardless of economic cycles, and around about, give or take, a 10% per annum yield. And then you have the benefits clearly of the ETF wrapper, where this is a liquid portfolio. A lot of these assets, sometimes people say they're private credit-like or light, but you don't have the lockups or any of the hassles associated with private funds. This is a liquid ETF wrapper that can be bought and sold with the tax efficiency of ETFs. So just to sum up, historically attractive distributions, consistent monthly income of $10.75 per share, 10-year track record, diversification, over 100 million in assets under management, yields that have historically averaged around 10% or exceeded 10%, and ability to enhance yield and or risk. To find us, please contact us at graniteshares.com or send us an email to info@graniteshares or call us on the number below. But thank you for listening. Let's have a chat.
Yeah, let's do a quick one. And I see there's maybe a couple questions here in the Q&A. How often is the portfolio rebalanced, and what is the portfolio turnover?
Yeah, so in terms of rebalancing, this rebalances on a quarterly basis. I don't have the exact number of the turnover, but it's relatively low. Again, this is, the pastoral universe is not that big in the grand scheme of things. But the main thing here is that it's, fairly standard in terms of turnover and or rebalance.
So obviously there's been incredible demand for anything that's got, consistent high yield, high income potential, certainly among retail, but that's growing obviously into the institutional advisor space.
Yeah.
You've got not just this, we also have a yield boost fund family, which we should touch on. But if you think about HIPS, if somebody wants to just generate a pure income only portfolio, like that's the only, objective, would you consider HIPS to be core to other fixed income? Would you consider it to be a satellite? How should one think about this within an income portfolio overall?
Yeah, I think it goes back to, ultimately your expectation and what the problem is you're trying to solve. So the problem that we were trying to solve is for the income investor that just wants consistent monthly income. So you might have, whatever the liabilities may be in your life, whereby whether it's a mortgage or whatever else it was, you need consistency of that income. And clearly the one thing that you get with the majority of funds or investments in the market, for better or for worse, is you don't have the surety of that distribution or the dividend. You might get a monthly dividend or a distribution, but that varies every month. And I think the problem that we were trying to solve with HIPS is the consistency. So making sure that with the fixed cash distribution, that whenever you buy in, so you can buy in today, you can buy in 6 months from now or 6 years from now, you're locking in that yield when you buy because of the fixed cash distribution. And that's a very attractive component to people. The flip side to doing that is that the NAV or the value of the fund rises and falls with the market. In other words, the value of the underlying securities that are in the portfolio, namely the BDCs, the REITs, etc. So because of that, some people will be completely happy with that. In other words, will prioritize the monthly income, understanding that, the value of the portfolio will rise and fall, with the market. For other people, that might be too much. And what they might want is more stability in terms of the NAV of the portfolio, and therefore the trade-off would be less yield. So it really just sort of depends on what problem you're looking to solve. And clearly this is not a substitute for a money market fund or something where you're going to have fixed NAV for the most part, and your principal is not at risk in the classical sense, but the trade-off is you're getting a commensurate amount of yield for that. And, that yield is going down, especially because you're at the short end of the curve, between now and the end of the year. And, who knows what's going to happen next year. And so I think that there's an opportunity for people that want to capture a high level of yield in an environment where yields now are falling. But in our examples, that's why we kind of show, okay, it's a 10% holding, a 20% holding. It doesn't really matter, but the assumption, I guess, to your point, Michael, is that HIPS is never going to be the entirety of your income portfolio, but it's a complement to existing portfolios where you can increase the amount of yield that you generate across the portfolio while maintaining the same level of risk, if not lowering your risk in the portfolio, given HIPS acts differently because you're not doubling down on duration or credit risk.
The big question, of course, with all these types of funds is how does this NAV erosion look? So there's a question here from Devin. Is there any NAV erosion over the years?
I mean, not really, to be honest. I mean, it depends on, again, what you mean by NAV erosion, because if you're talking about making a distribution that is in excess of the yield that's generated from the portfolio, then no, there's no NAV erosion. If you're talking about just making a distribution from the income that's received and not reinvesting it, then yes, there will be NAV erosion, because by definition, the fund pays out from the NAV to fund those distributions. But ultimately, the NAV of a portfolio in HIPS comes from the value of the underlying securities. And as I've said, the value of the underlying securities rise and fall with the market. So it's not a case that the value of the portfolio is constantly falling, providing, NAV erosion. The value of the underlying, as we've seen, in the sort of past here, which the one, I'll just go back to the chart quickly. You can see like it sort of appreciates or has appreciated, over time, but it rises and falls because these are securities in the market that, are priced by the market. And I think, what I would say to people is that, again, the objective here is consistent monthly income. So if you end up with a NAV that is, in and around the value that you've invested in, that's the win. It's not a growth portfolio. If you're looking for growth, this is not the investment. So I think there's always it's always a good question to remind people of, again, what problem are you looking to solve? That this is about generating consistent monthly income and trying to do it in a way that's sustainable, or as sustainable as possible over time, which you clearly see from the track record. This fund's been around for over 10 years, paid the same amount every month. The portfolio is still here. Does that mean that the value of the underlying goes up and down? Yes, it does. But that's a trade-off against the fixed value of the monthly distributions.
Let's talk about pairing HIPS against some of these other funds that you've got, in particular Yield Boost, your fund family, which I just saw crossed, I think, over 400 million. So congrats on that. We should hit on what Yield Boost. 500. 500. Oh, that was from last week. Look how quick you're growing. Let's talk about Yield Boost and how to fit that into HIPS.
Yeah, so this is a good segue into, again, the subject of risk and return. So Yield Boost, for those that aren't familiar, is a fund of options-based income ETFs. So that's a family of options-based ETFs that GraniteShares has. And they're most famous for paying probably the highest, but certainly one of the highest levels of distributions or yields in the market, in the entire ETF market. So to put that into context, if HIPS has an annual yield of around 10%, it's not uncommon for a Yield Boost ETF to have an annual yield of over 100%, and in some cases 150% or more. So people listening to this naturally would be like, well, how do you do that? Or how is that possible? And first and foremost, this is because the income is generated through a completely different way to traditional dividend stocks or from bonds. This is through options. And specifically, this is selling options to generate yield. And by selling options, you generate yield. These are typically referred to as covered calls or call writing or put writing strategies. For Yield Boost, it's actually an even more sophisticated strategy called a put spread, which is essentially a combination of selling a put option and buying a put option at the same time. But we do this on underlying leveraged ETFs. So to put that into context, if you were to sell an option on an underlying stock, let's for argument's sake, say Tesla, you might get the implied volatility of Tesla, or the option might be, say, 70. And if you were to sell exactly the same option on a 2 times leveraged Tesla ETF, then you would expect 2 times the implied volatility, so by 140. And so more implied volatility or a higher implied volatility means a higher notional premium. In this case, it would be 2 times the notional premium. Therefore, you have 2 times the amount to pay out to investors. Now, going back to the NAV question, if you look at something like yield boost, then again, the trade-off for having a yield that is, let's for argument's sake, say 100% or 150%, is that you have much more volatility with the underlying portfolio. So again, this is all about the trade-off between risk and reward, that you have a portfolio that is highly income generating, and yield boost also distributes on a weekly basis, which is interesting. A lot of investors we have want to be paid on a weekly basis. And so these funds do that, but they're ultra high income payers. And because of that, they have a much more volatile underlying than, say, obviously on the other extreme, a money market fund.
And again, go back to 400 million or 500 million, who's counting? Obviously there's big demand for that. Of that fund family,
I think it's the biggest growing category in the ETF industry.
Yeah, by far. Yeah.
And again, I come back to the same, although it's not the subject of today's presentation, it is within the context of today's presentation, because we're talking about alternative income. In other words, we're talking about the craze, the trend at the moment to generate income from sources that are not traditional, i.e. dividend paying stocks or bonds.
Anything that we missed here? So you mentioned, obviously falling interest rate environment, yield probably even more important, especially consistent high yield. Anything else that's you think should be addressed in the context of monetary policy with these products?
Well, we probably did miss something. I mean, there's always, I think the relevant fact is clearly that we're again in a different rate environment. And, while the short end, and again, we're talking about Fed funds, obviously when we talk about official interest rates, which if you look at the 10-year today, you might be thinking, the 10-year is going up and, Fed funds have gone down. But that is the difference between the market rate and, the Fed funds rate. But I think, again, it's, absent inflation and or, other market driven factors, we're clearly in an environment where interest rates, at least Fed fund rates, are coming down, and that will impact in the main holders of short-term fixed income and or money market securities. So, people that have been sitting pretty in money market funds, in short-term treasuries that were earning, probably close to 5%, that then went to 4% and is now, dropping between now and the end of the year below that. So I think this talks to another thing, which we didn't talk about directly, but we can talk about it now. Maybe it's a bullish factor or a bullish indicator that you'll hear people talking about for the market more broadly, which is there's this wall of money sitting in short-term money markets and or fixed income that presumably will seek a higher rate of return as rates continue to drop. That you'll hear a lot in terms of the further stimulus for the market, that money will have nowhere to go other than into the market. And, that's more demand for existing stocks, other investments, which, all things being equal, will help drive up prices.
Again, folks, for those of you here for the CE credits, I will email you afterwards to get your information submitted to the CFP board. Again, this is a GraniteShares sponsored webinar. For those that want to learn more about the funds, obviously visit graniteshares.com. Also sign up, put your email address there, get some great content from GraniteShares as well as on their Substack, graniteshares.substack.com. Make sure you also follow the GraniteShares handle, where rate distribution announcements for the various fund families are announced. I'm personally a big fan of HIPS, and I think as a diversified solution to income and generation, it's definitely done well.
Yeah, I mean, look, it's what's nice about it, and this doesn't get talked about enough, I think, is there's been a huge rush for private credit. Right? People have been piling into private credit funds, private credit solutions, all for the, attractive yields that private credit generates. But the flip side to that is that, people are locked up. And it probably sounds okay, when you sign up to one of these funds, they say there's a 3-year lockup or whatever it is, but time changes very quickly and things move on, and people that look to get their money back or get their money out, circumstances change, they can't do that. And a lot of the HIPS investments, well, I'm not saying clearly that it's private credit. It's private credit-like in the sense that a lot of these assets that you're buying in private credit funds are the same things we're holding in HIPS. It's just they're private instead of publicly traded, and certainly similar payoffs and profiles. But you get the benefit of a liquid wrapper, which, in some cases, there's pros and cons. The pro is obviously that you get liquidity whenever you want it, and you can buy and sell. The con, potentially, for those that make the private credit comparison, is that you have a NAV which is freely traded on the market, so a NAV that goes up and down, and you're not able to conceal the volatility of the NAV through a private fund structure, which is what a lot of what goes on, and the appeal of some of the private credit say, well, yeah, great, I get 8% per annum yield, but I've no idea the volatility of my NAV, or no idea the value of the underlying investments. So I think the more and more, at least what we see is, and that goes again to the popularity of yield boost, people are saying, you know what, I get the sort of the idea behind the private credit, and it's interesting, but if I can achieve the same yield with a publicly traded investment, or achieve, case of yield boost, clearly like way higher yields, then why do I need to go private or just buy an ETF?
I think that makes a lot of sense. I think that's probably a good place to wrap this webinar. Appreciate those that attended. Again, I'll send you the email on the CE credits. Learn more about HIPS again at GraniteShares.com. We're also doing another webinar talking about gold, which, if you haven't noticed, has been on tape for a few years. And GraniteShares has a fund there also, which is worth talking about. So stay tuned for that email announcement. Will, take it away. Anything that you want to wrap up with?
I think you hit on the points, but for anybody that, again, has questions on this webinar or anything we do, please reach out to us directly. Website is graniteshares.com. You'll find all the information on the funds there. We have multiple ways for you to reach out, from a chat bot on the site, which is a real person, by the way, to calling us, whatever mode you feel more comfortable with. Or, as Michael said, you can find us on social media at GraniteShares on X, myself, Will Rind, Substack, GraniteShares, and of course on LinkedIn. So please reach out if you've got any questions on anything that we do, or any ideas you would like us to bring to market. Always enjoy talking to everybody. But thank you, everybody, for listening today. Much appreciated.
Thank you, Bernie. Enjoy the rest of your day.